Welcome to your Market Brief. I'm Caroline Woods. Let's get the week started with Scott Galloway, noted author and NYU Stern professor. Following Casper's filing to go public and initial steps to list on the NYSE, Galloway says there are red flags to be aware of. Watch this.
It's a nice company, it's an interesting brand, but it's a $300 million direct-to-consumer brand, losing $70 million, operating margins of negative 20%. Where their negative operating margins seem to be going down a little bit, so there is some scale. But this company should not be a public company.
So Casper CEO calls you up and says, what do I do? What do you say?
Oh, three things. First sell, second sell, and third sell. This is a company that should have sold, probably missed their window 2 years ago. There are a lot of larger companies that I'll call going through a midlife digital age crisis where they need Botox and hair plugs in the form of cool little companies. Walmart bought ModCloth, Bonobos, Jet.com. And they got a lot of talent. They kind of signaled to the market that we get it. And when you make an acquisition of Jet of $3 billion on a $300 billion company, and you can say that our e-commerce is up X percent versus 0.5X percent, it's probably accretive. Now, a company like Target, you can see them getting big into sleep, a larger retailer. But a standalone specialty retailer that's losing this much money, it's hard to see how that's a viable independent company. And another idea, and I don't think this is going to happen, is there's some other great direct-to-consumer companies in the kind of innovation space. Away, the luggage company, and Warby Parker. I can see at some point if their valuations, all three of them, come down substantially, that they might be willing to try and create a new age Williams-Sonoma. But specialty retail is generally thought of as a company, companies when they go public that are supposed to be profitable. The other interesting tell here is the lead on the cover is Goldman Sachs. And to me, it's an indicator of just how terrible the retail sector is that Goldman has decided to try and take Casper public. You want to see a piece of creative writing? Look at whatever internet analyst is tasked with talking up the stock from Goldman of Casper. Because this company is a cute little company that has absolutely no business being an independent public company.
We followed up with Casper, but the company declined to comment. Let's shift to a public company now, Fedex, which has seen shares decline by 41% over the last 2 years. This comes amid a third quarter where profits dropped 40% versus the same period from the previous year. Here's Galloway's take.
I don't think they've innovated as much as, even if you look at on-time deliveries or even as a consumer, if you spend any time on the site, the UX feels very 2017. Online deliveries, both UPS and Amazon have better online delivery. I would argue that the senior management there has spent more time focused on tax avoidance than on actual innovation. And also they have a competitor, and this is the danger of a monopoly, that can build out a fulfillment network and then monetize it in another business. So what you see with Amazon and some of these big tech companies is what I call the featurization of entire industries. And that is they can launch scripted television non-economically, whereas media companies cannot, because they can monetize it by selling action figures, Mandalorian dolls, selling more handsets, or selling more paper towels through Prime. You're seeing the featurization of Hollywood to a certain extent, and you're seeing the featurization of delivery and logistics, and that is Amazon can buy their own planes, offer their own fulfillment at what is, in the short term, a non-economic construct, because the marketplace values that recurring revenue loyalty program Prime. So you're almost competing, it's almost an impossible task for FedEx. Yes, some of that is their own fault, their own making, but they're competing with a player that has almost zero cost of capital, which is a very difficult competitor to go up against.
They're just not diversified enough, it seems. So in the next 24 months, you say that FedEx will either be acquired or lose an additional 40% plus in value. You say the likely acquirer is Walmart, which really seems to concentrate the power amongst just one
small
more
group
company.
Of people. Yeah, that's a fair point. It could be a variety of people. So an interesting idea would be Shopify. Now get this, Shopify, the Canadian sort of software and e-commerce company, now has a larger market capitalization than FedEx. But if you look at the companies that have been able to add more than $100 billion of market capitalization over, say, a 2 or 3 year period, I mean, companies that really add staggering amounts of shareholder value, which is a great thing, and great for the economy and great for us, they have one thing in common, and that is they're totally vertical. They control the consumer interface, the front end, they control the operations, the supply chain, and the delivery. Right now, FedEx is on the back end. They don't control the consumer interface unless you buy directly from the website. So hooking up with a huge front end and a competent player such as Walmart, who, by the way, would solve their succession plan, has the capital, is really the only viable player right now, kind of going toe-to-toe with Amazon and actually landing some counter punches around click and collect around grocery. To me, that makes for an interesting potential pair up. It would also be about a 15 or 18% dilution, so it's a risk they could take. Probably the more interesting one, which would be a merger and a bet the farm, would be if Shopify, a Canadian firm, which quite frankly is an amazing company but probably overvalued right now, merge with Fedex to offer a full complement, software on the front end, keep your own data, and by the way, we can get your products there within 48 hours just like Prime.
That was Scott Galloway of NYU. We also reached out to FedEx and they told us the following. As a matter of policy, FedEx does not respond to speculation. Shifting to a quick update at upcoming events this week. On the economic calendar, the National Association of Realtors reports existing home sales for December on Wednesday. And on Friday, IHS Markit reports its U.S. Composite Purchasing Managers Index for January. In Washington, the impeachment trial of President Trump will begin today in the Senate. Plus, the World Economic Forum's 50th annual meeting begins today in Davos, Switzerland. This year's theme will be Stakeholders for a Cohesive and Sustainable World. Joining us for more is Barron's senior writer Leslie Norton, whose latest piece focuses on large cap mutual funds that have outperformed thanks to sustainable investing. Leslie, thanks so much for being here.
Thanks for having me.
All right, so there's clearly a focus right now on sustainability. Larry Fink just recently said that he's doubling BlackRock's lineup of sustainable funds. So clearly, ESG investing or environmental, social, and governance investing is a hot topic right now, but is it a sustainable strategy?
I think it is a sustainable strategy. We ran our 4th annual ranking of sustainable funds, and I can go into what we did to get that ranking, but what we found was that the funds that we deemed sustainable, deemed by Morningstar to be sustainable, actually outperformed the S&P 500 by a much greater margin than the other actively managed funds. And we think it's because these funds tend to invest in the same kinds of things that ESG managers tend to look at. They tend to invest in companies with good balance sheets, with good earnings. This went for a lot in a year, which was 2019, where earnings growth was very flat. So it has been 4 years that we've run this ranking, and every single year the sustainable managers outperformed.
So 4 years would maybe indicate that it is a sustainable strategy, but what specifically did you do or to come up with some of these sustainable names?
Right. What we did was we took the entire universe of large cap U.S. equity funds. We took out the ones that had less than $300 million in assets under management, and we also took out the funds that were deemed to be less sustainable by Morningstar. They had an average to below average sustainable rating. Just for comparison purposes, the S&P 500 has an average sustainability rating from Morningstar. And then we took the ones with high sustainability ratings, and then we ranked them according to how they performed in 2019.
So what challenges did you have, or what are some of those challenges that you came across in choosing these sustainable funds?
Right. Well, some of the challenges were sort of ironically that many of these funds do not regard themselves as explicitly sustainable funds. They just look for the same kinds of stocks that sustainable managers look at. Sustainable managers look for stocks that do well on environmental, social, and governance issues because they figure that these stocks and therefore the funds themselves will be durable for the future. These are durable business models. And one of the things we found was, for example, the first fund in our list, which is called Matthew 25, when I reached out to the fund manager, he said, "What's a sustainable fund?" But he invests in many of the similar funds.
So sustainable
stocks.
kind of by accident. Also,
yes.
Kind of ironic that Larry Fink said he doesn't actually invest in any of these sustainable funds himself, but maybe is getting there. We unfortunately have to leave it there. But I read that in your article, and I thought that was an interesting note.
Well, I think that he actually means to invest in them.
So, TBD.
Right. TBD.
Thanks so much for joining us, Leslie.
Thanks.
That concludes today's Market Brief. Of course, we want to hear from you, though. Comment below and tell us which mail carrier you trust the most: FedEx, UPS, the U.S. Postal Service, or Amazon. We want to know. I'm Caroline Woods. Thanks so much for watching.